The crash of 1929 is one of the most significant events in the history of the United States economy. It is also known as the Great Crash or Black Tuesday, and it marked the beginning of the Great Depression. The stock market crash of 1929 had far-reaching consequences that affected the entire world, and it is still studied and analyzed by economists and historians to this day. The Roaring Twenties was a period of economic growth and prosperity in the United States. It was a time of optimism, and the stock market was seen as a symbol of this prosperity. The stock market had been rising steadily throughout the decade, and by 1929, it had reached unprecedented levels. Investors were pouring money into the stock market, hoping to make quick profits. However, there were warning signs that the stock market was overvalued. The prices of stocks were not supported by the underlying value of the companies, and many investors were buying on margin, meaning they were borrowing money to invest in the stock market. The Federal Reserve had also been raising interest rates in an attempt to cool down the market, but this only made things worse. On October 24, 1929, known as Black Thursday, the stock market began to decline. Panic selling set in, and the volume of trading on the New York Stock Exchange soared. The market continued to decline over the next few days, and on October 29, 1929, known as Black Tuesday, the market crashed. Billions of dollars in wealth were lost in just a few hours. The impact of the crash was felt across the United States and the world. Banks failed, businesses closed, and unemployment soared. The Great Depression had begun, and it would last for more than a decade. It is estimated that the stock market crash of 1929 wiped out more than $30 billion in wealth, which is equivalent to more than $400 billion in today's dollars. The crash of 1929 was not just the result of a single event or factor. It was the culmination of a number of economic and social factors, including overproduction, income inequality, and excessive speculation in the stock market. The crash also exposed weaknesses in the banking system, and the Federal Reserve's ability to manage the economy. In response to the Great Depression, President Franklin D. Roosevelt implemented a series of economic reforms known as the New Deal. These reforms included government spending programs, financial regulation, and labor protections. While the New Deal did not end the Great Depression, it helped to mitigate the worst effects and laid the foundation for the modern welfare state. The crash of 1929 remains an important historical event that continues to shape our understanding of the economy and financial markets. It serves as a reminder that even the most prosperous and optimistic times can be brought to an abrupt end by unforeseen economic events. It also highlights the importance of strong institutions and government policies that can help to cushion the impact of economic crises on ordinary people.